Today, we're going to break down everything you need to know about mutual funds, one of the most popular ways to invest for both beginners and seasoned investors. We'll explore the different types of mutual funds like money market funds, bond funds, stock funds, and target date funds. Plus, we'll explain the differences between open-ended and closed-ended mutual funds. Before we dive into the details, let's start with the basics. A mutual fund is a type of investment vehicle that pools money from many investors to invest in a diversified portfolio of stocks, bonds, or other securities. It's managed by a professional fund manager who makes the decisions on behalf of investors. Mutual funds are popular because they allow people to invest without having to pick individual stocks or bonds. Now, let's explore the main types of mutual funds you can invest in. First, we have money market funds. These are low-risk funds that invest in short-term, high-quality debt securities, like treasury bills and commercial paper. They aim to offer a safe place to park your money while earning a small return. Think of it as a low-risk savings account alternative. Next, we have bond funds. These funds invest in government or corporate bonds and offer a relatively safer investment compared to stocks. They're typically sought after by investors looking for a stable income, as bonds pay regular interest. However, bond funds are subject to interest rate risks, meaning their value can fluctuate with changing rates. Then, there are stock funds, also known as equity funds. These mutual funds invest primarily in stocks. Stock funds can offer higher growth potential but come with more volatility and risk. Some stock funds focus on specific sectors, like tech or healthcare, while others aim for broad market exposure. Lastly, we have target date funds. These are designed for retirement or long-term goals. They automatically adjust their asset allocation based on a target date, typically the year you plan to retire. Early on, they invest more aggressively in stocks, but as you near your target date, they shift toward more conservative investments, like bonds. Now, let's talk about the structure of mutual funds. Mutual funds come in two main categories, open-ended and closed-ended. An open-ended fund is the most common type of mutual fund. In these funds, shares are bought and sold on demand at their net asset value, NAV. Investors can buy and sell shares directly from the fund at any time. The number of shares can change as investors come and go. Open-ended funds provide liquidity, meaning you can buy or sell your shares at any time. On the other hand, closed-ended funds have a fixed number of shares that are issued during the fund's initial public offering, IPO. After that, these shares are traded on the stock market just like stocks. Unlike open-ended funds, you can't redeem shares directly from the fund. Instead, you have to sell them on the market. Because of this, their price can fluctuate more than their NAV, depending on demand and supply in the market. So how do you choose the right mutual fund? It depends on your financial goals, risk tolerance, and investment horizon. If you're looking for safety and liquidity, money market funds might be your go-to. If you want steady income, bond funds could be a great option. For long-term growth, stock funds or target date funds may be more suitable. Mutual funds are a versatile and accessible investment option, offering a wide range of choices depending on your risk appetite and financial goals. From money market funds to stock funds and open-ended to closed-ended funds, there's a mutual fund for every investor. The key is to pick the one that aligns with your strategy. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and drop your questions about mutual funds in the comments below. Until next time, happy investing!